JP Morgan Asset Management's Gabriela Santos and Invesco's Brian Levitt. It's good to have you both here. Okay, Gabby, you first. Size it all up for us. What do you think?
I think we're really in the depths of the policy storm right now, and I think it's tough for anyone really to have a lot of conviction around forecasts for economic growth, for earnings growth. I think we've taken some of the tail risk or worst case scenario off the table. We seem to have dialed down some of the actual tariffs themselves, but it's still hard to feel your way around where we're going to end up. What is the base case on tariffs, and what does that actually mean for economic growth and earnings? So when that happens, you see higher volatility. The VIX still suggesting up and down days of about 2%, or that's what the implied volatility is. But low conviction doesn't mean no action. And what we see a lot of our clients doing is just strengthening the core, meaning having more of a balanced allocation, stocks and bonds, having more of a balanced value growth, rebuilding core fixed income for diversification, and waiting to have a little bit more clarity before stepping back in to take some risks.
Should we think that these, bouts of extreme volatility are not over? Is that how you're generally approaching?
Yeah, I don't think the extreme volatility is necessarily over. The good news is that there are pain points for the administration. So on the morning of April 9th, we weren't sure when we had trouble with the plumbing in the bond market, is there a pain point? This Monday, we've had a good week. But remember, this Monday was stocks down, bonds down, currencies down, right? That was disconcerting.
Yeah, because we were wondering whether the Fed chair was going to be down.
Right. So do we have to go from pricing a correction to a recession to stagflation, right? And stagflation environments don't tend to be good for risk assets. So we're still moving through this. The policy uncertainty hasn't disappeared. I think on days like this, the last couple of days, it's a little bit of a rejoicing that the administration does have a pain point. Reciprocal or Liberation Day may have been the worst of where we were, and things will get incrementally better.
Incremental steps, to Brian's point, good enough as long as we have a backdrop of what some have suggested is a tonal change from the White House, and then just no more well, maybe we still get the bashing of the Fed chair, but no more talk about potentially firing him.
When it comes to tariffs themselves, it has been really important since April 9th to have a toning down of the actual implemented tariffs and this 90-day pause on the so-called reciprocal tariffs. But I don't think it's just about how loud the volume is on tariffs. I think the level themselves really matter as well. And we would feel a lot better about future economic and earnings conditions if they get dialed down a bit further. I mean, having an effective tariff rate on Chinese imports of what we calculate to be 110% is just not, as Treasury Secretary Bessent used the word, sustainable, right? You're basically charging importers more in tariffs than the value of the good. And it's just not a situation that's really tenable here. So we would like to see actual dialogue between the U.S. and China, reduction in those China tariffs, and then a more permanent postponement or cancellation of the reciprocal tariffs to then be able to better digest what this all means for economic and earnings forecasts.
At what point on that note do we sort of cross the Rubicon of not being able to come back soon enough? If you listen to the commentary, from Chipotle on the back of their earnings, the frequency of visits being reduced by consumers. Some of the airline commentary is fairly negative. Tariffs have been cited on more than 90% of S&P earnings calls this season. The staffing firm Robert Half slashed its guidance because of everything that's going on. That's a somewhat ominous sign for the strength in the labor market.
It is, and leading indicators of the economy are certainly pointing lower. If you look at sentiment on the business side, the consumer side, pointing lower. So if you're investing on a tactical allocation basis, given where leading indicators are, they're pointing to below trend growth and deteriorating. So you would want to be more defensive here. The challenge that we have is the market's priced in some of this pretty quickly. Does it get better? And so the market bottomed on April 8th because things have gotten incrementally better. The hit to the economy is coming, right? And so
there's a lag.
But there's a lag, right? So any economic data releases we're getting right now, first quarter earnings, the guidance matters more than what you're on the earnings calls than what you're actually hearing.
It doesn't need to be that. It doesn't need to be necessarily the worst case scenario, though. Just as, the White House initiated all of this.
Yeah.
better outcomes can be reached maybe sooner than expected, and a lot of it can be reversed reasonably quickly.
A lot of it can be reversed reasonably quickly. What you'll need to see is businesses believe that the worst of it is behind us, that we're moving directionally in the right way, and start turning our attention to the extension of the Tax Cuts and Jobs Act and deregulation. You know, a lot of talk of, well, is money going to flow out of the United States? There's not going to be foreign investment in the United States. If we could start working on deregulation, enticing money back in, then, yeah, the pain may not be as bad. But right now, it's a tough policy mix. Uncertainty means lack of investment.